This episode of the Alt Goes Mainstream podcast is brought to you by Ultimus, a leading full-service fund administrator for asset managers in private and public markets. As private markets continue to move into the mainstream, the industry requires infrastructure solutions that help funds and investors keep pace. Ultimus is a leading full-service fund administrator for asset managers in both private and public markets, offering a wide range of capabilities across registered funds, private funds, and public plans, as well as outsourced middle office services. Delivering operational excellence, Ultimus helps firms manage the ever-changing regulatory environment while meeting the needs of their institutional and retail investors. Ultimus provides comprehensive operational support and fund governance services to help managers successfully launch retail alternative products. Trusted by institutions, investment consultants, registered investment advisors, state governments, and fund managers, Ultimus provides solutions for nearly every investment structure in the marketplace. Visit www.ultimusfundsolutions.com to learn more about Ultimus's technology-enhanced services and solutions, or contact Ultimus Executive Vice President of Business Development, Gary Harris, on email at gharris@ultimusfundsolutions.com. We thank Ultimus for their support of Alts Going Mainstream.
Everybody gets a piece, we're going mainstream. Everybody's gonna eat, we're going mainstream. All my family is sing. See you on Main Street, we're going mainstream.
From Wall Street to Melrose Avenue,
We're going mainstream.
venture capitalists to athletes to
We're
creators
going mainstream.
to the person who's collected trading cards
We're going mainstream.
in a collision of culture and finance.
We're going mainstream.
Welcome back to the Alt Goes Mainstream podcast. Today's episode is with two executives who have helped to build one of the industry's leading alternative asset managers. We sat down in Permira's London office with co-CEOs Brian Ruder and Dipan Patel to discuss the firm's evolution and how the business has grown to over 80 billion euros in AUM. Both Brian and Dipan bring deep backgrounds in private equity investing to bear as they now lead the firm through its next phase of growth. Brian joined Permira in 2008 after working as a partner at Francisco Partners. He's co-managing partner and co-CEO of Permira, also serving on the firm's executive committee and the buyout fund's investment committee. He was instrumental in building out the firm's technology sector team, which he co-led until 2023, where he worked on a number of the firm's notable transactions, including Ancestry, Genesys, Informatica, LegalZoom, Magento, McAfee, Relativity, Zendesk, and more. Dipan joined Permira from Gores Group and is co-managing partner and co-CEO of the firm. He serves on Permira Holdings Limited Board. and Permira's investment committee and executive committee. He's focused on technology and services investing, working on deals such as Renaissance Learning, Informatica, Axiom, Adevinta, AllTrails, Ancestry, LegalZoom, and more. Brian, Dipan, and I had a thought-provoking conversation about what it takes to build and run a scaled alternative asset manager and how to differentiate a firm and a culture. We discussed the founding story of Permira and the evolution of the firm since spinning out of Schroeder Ventures in 1996, how the firm's beginnings have shaped the culture that has been built, and how the culture has permeated into how they make investment decisions, work with companies, founders, and LPs. How would an LP underwrite Permira's culture? How the firm's European heritage helps as an investor, the opportunities set in Europe, the investment culture at Permira, and how its structure and setup helps investment processes and decision-making, why software buyouts have become a larger part of the buyout investing ecosystem, how AI is impacting software investing, and how AI is impacting services businesses, why the firm has expanded into credit, and the thought process behind launching a wealth solutions business and how it reflects the culture of the firm. Thanks, Brian and Dipan, for coming on the show to share the evolution of Permira and your expertise and wisdom in private markets.
In a collision of culture and finance.
We're going mainstream.
Brian, Dipan, great to have you on the show.
Thanks for having us.
Great to be here, yeah.
Pleasure to be here as well. I think fascinating conversation of evolution of a firm that has gone through leadership changes to the next generation, grown as a business, both European heritage, based in North America as well. I'd love to get into all this. So first, I'd love to start with your backgrounds, because you've been through multiple cycles as investors. You've seen the evolution of Permira as a firm. So would love for each of you to share just how your career trajectory has evolved as private markets has evolved. So Brian, start with you.
Yeah, I started in private equity almost 30 years ago. This is my 29th year in it. So I've seen the cycles through .com boom and bust, of course, the financial crisis, COVID, everything that's been going on for the last 24 months. But maybe even more important than the cycles is just the evolution of the industry over that period of time. Because for sure, when I started in the industry, it was a very niche segment. I mean, private equity sort of occupied a certain role in the ecosystem, which was kind of the 7 times EBITDA quirky businesses that didn't really fit the public markets, didn't really have high strategic value. And that's kind of what private equity did. You levered businesses up and you ran them for a while, and eventually you found somebody else to buy them. Maybe you took 1 or 2 public. And what's happened since is that we as an industry, and for sure Permira, we've done this over that time period, is found the way to address really the entirety of the market, and especially getting to the better businesses in that ecosystem. Every segment of the economy, every sector in the economy, you can tackle with private equity. We today focus on really 4 core sectors in technology, consumer services, healthcare, and that kind of sector-led approach where really any business of any quality kind of is within our lens to be able to drive value and get, private equity style returns from, is a very significant opening and widening of what that ecosystem has been. And then, of course, within that, you have kind of all of the cycles, the macro, micro cycles that happened during that time, which tend to be, for lack of a better word, catalyzing events to really hone and continue to develop your knowledge and expertise. So, it's been an amazing journey. Back then, when I first started, the firm that I was at, we were managing a $1.5 billion fund, and that was big. That was considered to be very large. And we actually discussed at the time whether, was the industry hitting kind of the peak levels? Can it get much bigger than this? And you look today where the largest funds are, well north of 20 billion. And it's just because of that, just significant widening of the aperture of where we can apply ourselves.
And Dipan?
Yeah, so look, I grew up here in the UK. My first job, which was actually out of school because I took a year off between school and university, was at Arthur Andersen. Arthur Andersen was one of the big 5 at that time. It was the highest growth accounting firm. I was actually there in the year that the Enron scandal happened and the company went bankrupt. That was very instructive because it was my first formative experience in a real company. Went to university, came out, joined Lehman Brothers. Lehman Brothers also in the years I was there for 4 years, was one of the fastest growing investment banks. Incredible place in many ways, and was there until Lehman Brothers went bankrupt in 2008, and then joined the private equity industry in 2008, and so have been on the West Coast with Brian for a number of years here in London, involved really with software and services and internet investing through that period.
I think that's a fascinating perspective because there's two elements there. One is software investing has gone through so many iterations and evolutions, and you both have seen that from investing earlier in your beginning of your career, seeing the .com boom and bust, and then going through other elements of the market's change. But then the other piece that's interesting as well, you said, Brian, which is that private equity is now a lot of different things at different parts in the market. You can invest at different stages and in different ways, and that's expanded the industry. You could also say the same about private credit too, which you've gotten into in your own way. I'd love to unpack that a little bit because I think that's instructive to how you think about the firm and the evolution of the firm, but also how you think about investing. And I think your backgrounds are pretty instructive for that. So I'd love to discuss what you said a little bit more, Brian, which is what was the point at which you realized as an investor that private equity is different than it was in the earlier days, as you described?
I don't think there was no magical moment where suddenly the industry changed, but it attracts a very dynamic group of people. And by the way, I should say it's a really fun job, right? You get to work with companies, improving companies, and it's not just one company. You can do that with like multiple at a time, and you cross-pollinate kind of the learnings across different industries and different areas. And so it's been this very continuous evolution. And I'd say for us during that time frame, and Permira, we're now 40 years old this year, and we're a firm kind of built by and run by entrepreneurs. To me, the consummate what entrepreneurs do is find ways to push into new areas, kind of unserved areas. Like, I see something there, and I'm going to go capitalize on that opportunity by like building something into that. And that's kind of what we have done. And like we Permira have done that. We the industry have done that continuously. Like every year is find a way to get a little bit more, market into how we can address what it is that we do. And technology is just one of the, it's probably the best example of that, because it was considered to be sort of off limits, right? Technology risk just isn't something that people who have more of a financial bent can do or can take. That's kind of it's the domain of the venture capitalists. And I remember when I started in the industry and people would say, software you can't invest in because, quote unquote, the assets go up and down the elevator every day. And that was one of those phrases that sounds like wisdom, right? Until you really think about it and you're like, what a dumb statement that is, right? Like, so you have these businesses that have tremendous intellectual property, like tremendous embedment with their customers, but their product is shipping bits instead of shipping boxes. They're way better businesses than the physical product businesses. And so as the industry started challenging some of these established truisms, boom, you open up this ecosystem that actually is phenomenal for what we do. Like, there's really good growth in technology and software. You can actually leverage these businesses. So like the balance sheet dynamics there, whilst not being kind of the reason to buy one of these companies, they're very stable, very profitable, recurring businesses, which are really well suited towards using financial leverage, which is, it's a tool in the toolbox of what we do. And kind of really going back to, that from the very early days, like my very first few transactions that I worked on were technology businesses in the mid 1990s as buyouts. And that to me was like, aha, there's an enormous amount here. This is what, I actually chose at that time. Like, this is where I want my career to go. I want to be a technology private equity investor.
Dipan, what do you think investors are missing about what Brian just said, that people couldn't necessarily see technology investments as buyouts in the way that they do today?
At that time, look, I think Brian covered it. I mean, we most investors at that time were looking to put leverage on businesses and scale leverage for the first time in what was a relatively new way. And the common wisdom at that time was that needed to be asset backed. And as Brian said, it's the core asset is the IP and billions of lines of code that sit within software companies, and that wasn't immediately obvious to people that you could leverage that.
How does AI change things, if at all?
Look, I think it depends on which segment you're in and the nature of your market position. AI fundamentally, you just step back for a second. This is a platform shift, and platform shifts are big deals in technology. So whether it was it's PC or mobile or cloud or client server back in the day, all those things played out over very long time frames. So what they did was spawn new applications and thousands of new applications on top of new platforms. So this is a big deal and will be a big deal, and it'll probably play out over a very long time frame. Today, if you're a software company, or frankly any company, and you have access to unique data, i.e. data that's not available in general training sets that you can use to improve your product and generate a product flywheel, it will be an amazing growth accelerant for most companies, not just software companies, but any company that has that position.
What's interesting there too is you invest in technology all the way from growth to buyout, but you also invest in services business as well. And services businesses can also apply AI. How do you think about the application of AI to the companies you're investing in? Is there a different risk reward outcome that now happens with AI where good services businesses become even better, or good technology businesses become even better, and then that makes private equity even just a different underwrite for LPs when they think about it, where you're taking a good business and you're taking it from a rule of 40 to a rule of something greater than that just because what it can do to margins? Does AI really change how you think about private equity investing and what the risk looks like at various points along the spectrum, Brian?
Yeah. Yes. So I should say like this, I'll talk about like how we're organized for this, and then why we think this is actually an amazing time to be investing actually across all the sectors that we're in. So we have a sector-focused approach. So we're leading with content and expertise in our 4 core sectors. So like our tech team is like very deep in tech. Our healthcare team is very deep in healthcare. But then those teams don't operate autonomously, they operate together. And most of the investing that we've done are digital businesses, between consumer digital, enterprise digital companies, software, internet, you name it. And in this era where AI is it's not just going to hit the technology industry, it's going to transform really everything, we think. In some ways, very fundamentally, and in some ways, it's just going to make it a bit better. But it's going to hit and transform really, we think, all segments. So for us, being able to apply that digital expertise and capability across all segments of the economy, very critical asset, we think, for the next 10 years. If you look backwards in private equity, 10, 20 years, where you kind of wanted to be was a tech specialist. You only want to be doing tech. In the next 10, 20 years, we think what you want to be is what we are, which is a tech specialist, but applied generally. So multi-sector, tech-led, but not tech only, so that you can apply the best of, particularly AI, into some of those other segments, healthcare, services, and the like. And so with services is, let's say technology businesses. Every technology company that we see is investing heavily in AI today. Some to the greater or lesser effect. They all believe, they all have engineers, they're all investing in it. Either the tool, for sure the tooling to make their developers more efficient, usually to make their products better. Our directive to all of our companies across all our sectors is be the leader around AI in your respective sector. That has been the case since really GPT 3.5 came out, and that's really paying off. So like our companies are actually releasing AI-enabled products today that are having real effect in their customer base. And in service, and so in software, that's great. It's going to make the software industry better. It's going to make it more efficient. It's going to make for better products over time. But everybody's kind of investing in it. So it's going to, we think it's less likely to like disrupt the stack ranking of the companies that you invest in there. Service is very different. So there it's going to have an impact. But if you meet, 100 services companies, less than 100 of them believe that AI is going to change their industry. More and more every day, but like less than 100. And then of that group, actually a pretty small percentage have the internal capability, engineering capability, technology capability to actually fully take advantage of that. And we think that's the opportunity.
Is that where private equity can really help change and transform these industries? Because you can come in, make these businesses more efficient, maybe do roll-ups, add things like AI to some of these services businesses and just change the way that they might think about doing business?
Yeah, I mean, in AI, it's actually the ability to identify early who we think the winner is going to be. And you find like the right team, the right set of assets that are going to really be the leader already in AI. We own this company in Permira 8 called Octus, is exactly that. It's a data service provider to the credit industry. And that CEO and founder was like very much has the vision of like, I'm going to be the AI leader. Like, yes. Or you find a business and industry where you can bring something to it and help, especially with our governance model, which tends to be control. And we're like nice control people, right? But we want to, like, the way that we are able to do is partner with our management teams to really go in a direction that is very hard to do with a distributed board, distributed shareholder base where there might not be that much alignment, and really transform the business towards AI. And like to say it's not so much like roll up, but, bring some expertise, bring some recruiting capabilities, change kind of the structure direction of the company to be able to take advantage of it, and thereby generate alpha. And that's where like services, we think, you can really disrupt that stack rank of the competitive order if you find the company who might be, the number 2 or 3 player, but has the right attitude and mindset, can really rapidly go to number 1 in that case.
That feels like a cultural imperative from top down. Do you think that in today's world, if executives and CEOs aren't thinking about AI, that puts them at a disadvantage?
For sure. Look, I think over the short term, maybe not. And it's hard to talk about these things as generalizations. You have to go asset by asset and sector by sector. But generally, probably over the next couple of years, probably not. Over a 10-year period, almost certainly. At some point we said, you start saying every company is a software company in one way or the other. Eventually that will be the case with AI. It will go from a set of fringe companies that are really leaning into AI to most companies using AI, to a point where if you're not using AI, then you're going to be really stuck. There's the old saying about how do companies go bankrupt? They go bankrupt slowly and then suddenly. And there'll be a lot of companies right now that optically, if you just look at the face of their P&Ls for the next couple of years, will probably do just fine. But played out over a long period of time, it'll be problematic.
What you said it makes my mind go to the place of, we're in an interesting time in private markets and private equity in particular, where this concept of companies either struggling or going bankrupt slowly and then suddenly, it feels like, since we're at this inflection point in terms of a platform shift with AI and some companies adopting it faster, like you say, Brian, and others maybe adopting it a bit slower. How do you think about underwriting deals in today's world?
Yeah, I mean, look, first of all, we've always been market leader snobs in our firm. I think that's only going in one direction. So, not just being the market leader, but the distance that you're the market leader by. That in and of itself is not going to protect you for forever, but it's a great starting point to have. So that's one. The second is, the degree of embedment you have. I mean, you take services. It's easier in software because you've got naturally recurring revenue and sticky business models by their nature. It's priced that way and it's embedded that way from a workflow perspective. Within services, you have a full range. You have companies that are deeply embedded in companies' workflows, and you have companies that are episodically used. We have generally steered away from companies that are episodically used. But today, that would be absolutely no-fly zone for us. You need longer-term contracts and a deep embed in the workflows of your customer, or we wouldn't want to be an investor in that company. And then CEO, right? I mean, fundamentally, all these things always get driven by senior leaders. It cannot be a side project. It can't be an initiative. It can't be board driven. It needs to be driven by leadership. You take Zuckerberg at Facebook. If he doesn't buy WhatsApp and Instagram, that company's dead. If he doesn't say all engineering is going to be mobile first, that company's dead, right? And so it's sort of that mentality and coming from the top. If that had been a CTO project or a initiative inside Facebook, there would be no Facebook today. Right. And that's the case in micro examples for everything that we look at, which is why we are so, having a control model and control orientation is so important today. When you've got fragmented boards and ownership and tenures within those ownerships, you get stuck in debates on these things, and speed kills. Right, velocity. If you look at a lot of companies, lack of velocity is an absolute killer. And Brian says this all the time, that you judge a company or a management team by how much changes between boards, right? And there are actually amazingly a lot of companies where you're still talking about the same things 2 years in that you were talking about 24 months ago. And there are some companies where the rate of innovation is incredible, and we sort of look for that in our underwriting.
Yeah, that's the from board meeting to board meeting, you tend to meet quarterly. The test is how much time feels like passed between board meetings. And there are some companies where it's 3 months later, but you feel like you have no time has passed. It's like we're talking about the same topics, but the same progress. And then there's some companies where you fast forward 3 months and just feels like a year has gone by. You're like, oh my God, these guys they've gone through 2 or 3 iterations on a problem, right? They haven't just brought a problem to the board. It's like, oh, by the way, here's some problems that came up and we've just like solved those. So those are the kind of dynamic, setups that we're looking for and trying to back.
I think related to that as well, because things are moving so fast. But then it's not just AI, but the way technology has evolved has made certain companies able to move faster than others. Obviously, some do, some don't. But in the context of AI, do you think it benefits larger companies more than it benefits smaller companies?
In general, yes. But there's kind of like tiers of size. What I'd say is like we think that, put size aside for a second, that the primary beneficiaries of this wave are going to be the technology forward incumbents. And like all of those words are important to us. So incumbency by itself, we think is not going to be entitlement to success in this generation. And in fact, it could be the enemy because incumbency by itself creates laziness. This is sort of the core of the innovator's dilemma. And we are like straight in the bullseye of innovator's dilemma type territory today. But incumbency, actually, there's a reason for that. And then incumbency has a set of assets to it that if you capitalize on those can really be powerful. And so that's where the technology forward piece is that the businesses that have the benefits of incumbency, which in an AI era, it's customer relationships, customer trust. Those are really hard to build. It's got data, right? That's actually crucial to training these models to be able to establish, kind of AI enabled or AI only workflows. And it's got the workflows as well, like understanding this works. And what's amazing about this technology, let's say different from the cloud era, like to really take advantage of cloud when you're moving from the premise to cloud era and software, you actually had to really rip out your infrastructure and go with a completely cloud solution. In the AI era, it didn't, the partial cloud solutions, which a lot of the incumbents tried to implement, just didn't really work. If you look today, like basically none of those are still in the market. They all failed over time. And so incumbents that are able to plug those into their workflows, we think are going to generate actually quite a bit of, value for their customers. And there's the constant divide of the truism is, or like the rubric, do the startups, the disruptors achieve distribution faster than the incumbents achieve innovation? Yeah. And like the startups in this era are going to get funded and they will, eventually they'll find their way to distribution and kind of getting to the customers. But if you are the incumbent with those customers and you find your way into innovation, like these tools are very available today. We think there's a lot to capture there.
What's fascinating about how you just described the types of businesses you like to invest in, technology forward incumbents, I think that actually describes Permira quite well, in a sense, if you think about that. And I'd love to unpack that because if you think about as a firm, you're a leader, but yet you're trying to continue to innovate. You're moving into new parts of private markets, credit, which you've done for a while now, the wealth channel. You're constantly evolving the firm. You've gone through leadership transitions to the next generation. I'd love to unpack the concept of what you just discussed in terms of how you underwrite businesses, in terms of how you think about building the business of Permira. So, Dipan, why don't we start with you in terms of your perspective on how you think about changing the firm, and Brian, would love to hear your perspective on how you just thought about underwriting businesses in the context of how you underwrite your own business as you think about growing.
Yeah, look, I think it's the old thing that Andy Grove said, that you're either niche or you're broad or you're dead. And, we are a niche focused, specialized private equity fund. We know who we are, we know what we like to do, and we want to go deeper and deeper and deeper. So like our firm growth will come from scaling what we're in. And fundamentally, that will be a function of getting better and better and better and generating industry-leading returns over long periods of time in the core of what we do, right? So whenever we think about, the strategic choices we're making, they're all about capability building in our core. It's really as simple as that.
So I want to take that point, capability building at your core. And if we unpack what you said, technology forward incumbents, let's unpack each of those words, like you said, in the context of Permira.
Yeah, we have a set of values, and you'd hear this from anybody at the firm. We don't like pound this into people, but people who've been at the firm for a little bit, like the values just resonate, right? So these aren't things that you teach people the values as people kind of learn the firm. And then you say, like, by the way, our values are these 3 words. And everybody's like, of course they are. That makes complete sense to me, right? The people don't understand. And so they will reiterate that over and over again. And they are creativity, partnership, integrity. And it's kind of nice to have, some labels on that, because it just sort of crystallizes what we are all about. And, creativity, it's about finding answers that other people might not have found and looking for solutions that, just aren't tried and true necessarily. And that's like, what a great way to generate, good investment returns. Partnership is really about both inside the firm, collaborating across any boundary, collaborating with our management teams. Like, we're very, we want to work with other people. Like, we believe that we are vastly better as a collective than we are as individuals. And then integrity is just do business in a way that you will stand the test of time, be honorable, be truthful. And that's, we hold our standard of behavior privately, publicly in such a way that, any of our investors will be proud of any decision that we make on their behalf. We operate in 4 core sectors in private equity, and we have a growth strategy and a buyout strategy. Our growth strategy is focused really on higher governance, but like mostly minority use cases, kind of one earlier tick in the market. And if you looked at how we could present ourselves, you might put, here's how much we've done in consumer, and here's how much we've done in technology, here's how much we've done in healthcare and in services, and here's what that looks like across buyout strategy, growth strategy. It's a bunch of boxes on the page. And if you look at some of the firms that we might get lined up against, they would have similar boxes on the page. The difference with us is that with those firms, the box is actually a separate box, separate dedicated team that just operates on its own, their own little piece of the product. In our case, we want to be deep, deep, deep in each of those categories, but there's no boundaries on the box for us. So like, our teams are operating completely fluidly, very integrated across all those. The buyout and growth teams are the same, right? Same teams are investing those 2 products. And across the sectors, there's like free bleed between each of the sectors that we're investing in. So especially in this current world we're in, it's hard to find a business that shouldn't describe themselves as being technology oriented in where we go. Like, you should need to and want to be investing in technology somewhere in what you do, even if you're not a technology company. And so having the ability to have fluidity of our teams to be able to get the right people to show up to assess and drive value in a company, absolutely core to what we do as a specialist.
What's most beneficial about having a team focus from growth to buyout as one team? Because those can be very different, not just
IP
stages of the market to have to cover.
It's IP and its network, right? As simple as that. So, in any segment that we're looking at, and we talk about our 4 core sectors, but actually that's what we say externally. Internally, we run as very subsector focused within each of those. And within any subsector that we're looking at companies that will have $50 million of revenue all the way to multiple $1 billion of revenue. And the same teams will be looking at businesses right across that spectrum and networking with management teams right across that. And so the thing that we scale here is IP across that. There are sub-segments where you want to be backing the earlier stage companies. And there's some segments where you want to be backing the incumbents. And you only know that if you get to look right through the stack.
So there's 2 things there that are interesting. One that I think probably helps the underwrite, which is you're able to decide at which point in the risk spectrum you want to play. You can wait for a business that's at growth stage to get to the next phase and say, okay, maybe it's a little bit de-risked. I pay a little bit more, but it's worth waiting. There are other times when you want to be earlier. Does that, though, make it harder as an investor in terms of the mindset that you have to have? Growth investing mindset at times may be different from a buyout mindset. And how do you train your team to think about that, of know when to have the different viewpoint of how to underwrite a business at each stage?
Look, I think we are a growth focused private equity fund in everything that we do. And I think we're very distinct in that sense as a large cap fund. There's very, very few large cap funds that bring a growth mentality to every stage of investing that they do. And sort of what does that mean? It's easy to say those words, you're a growth oriented investor, but what does it mean? It means that you take a truly duration mindset. And that's not just about holding businesses or holding businesses for longer. It's the types of discussions that you drive in the room. We want to be the best owners of every company that we invest in. So whether we're looking at a growth stage company or we're looking at a scale company, we actually are driving the same types of discussions in the room. Like very similar. It's really all about how do you drive terminal value for this business, which is not about how you drive EBITDA in the next few years, but how do you make this an enduring company for the next 10, 15, 20, 30 years? Ultimately, that's what you get paid for as an investor at any stage that you're investing in. So it's actually not that hard for us. It's pretty seamless.
That's why we tend to be backing most of private equity, we'd say, is helping companies optimize their year one EBITDA margin. That's like the history, and like that, it's a very good way to make money in certain types of businesses. We're trying to optimize, year 6, year 7, total dollars of EBITDA. Like we love profitability. Profitability is great, but we care about long-term profitability. That's what generates compounding returns for us and for our investors. And what we've looked at for our realized companies, the profile of the businesses that we can get them to in year 8, 30% EBITDA margin, 18% growth, organic growth. That's like the profile of our year 6 portfolio. That's a really, really valuable portfolio kind of approach. It's very hard to find, especially today, businesses that can grow that well and produce profitability. You don't get a profile like that in year 6 by jacking your margin up to 45% in year 1. And so that's very endemic to our philosophy, is backing growth teams, growth products. And by the way, on the ground, like, what does that mean? It's like easy to say. Everybody says they would like to back growth. For us, like, what it means is actually putting the investment into these companies early. We've taken Informatica. We took private in 2015. We immediately put money into building a completely cloud native solution that came out. And today, guidance this year will be $1 billion of annual recurring revenue from zero when we took them private. Salesforce buying the company. This was a core part of what they were buying. This is what they wanted to buy. Created strategic value and financial value. The two of us worked on Ancestry.com. Ancestry we took private in 2012, and they had this like nascent idea to do a DNA business on top of genealogy subscription online. Most people in our world would have shut that down. We knew it. People looked at it like, what a dumb little experiment this is. And we saw something different, backed the team to really build that into, multiple hundred millions, I think at the peak, more than $1 billion of independent revenue in that DNA offering, and exhaust into the core subscription. And so these are the mindset of, we want to be in the product strategy with these companies and with these teams to be able to drive growth, not growth at all costs, but, really profitable long-term growth. And that has really worked for us.
What do you think is the skill set that it takes to have that type of mindset when it comes to private equity investing? Because that, to your point, that's different than just saying, let's just focus on margins right from the start. They're not important, they are, but that's very much a different mindset when it comes to underwriting, and even probably before you start dealing with a company and partnering with the founder and executive team.
It's not one thing, but it's some combination of culture, mindset, skill set. And in some areas, these things overlap. I think the starting point is the way we run our firm. Like, it's core DNA for us to assess the quality of what's going on by the nature of decisions that are being made for the long term and how that's translating into that might translate into long-term outcomes. So, we have portfolio review committees. and we assess the performance of our companies. In most GPs, the focus will be on a strict financial comparison. What did we underwrite and where are we? That's a component of how we look at performance and how we track performance. But we're just as interested, frankly, more interested in, are we making the right decisions? Have we made the right management changes? Are we investing in the right products? Are we expanding our channels? Are we really setting this business up to be an enduring company? So the starting point is the people in our firm need to be empowered and feel empowered to think long term. And they certainly have the permission to do that from the leadership team of the firm. Sorry, did you want to ask something?
Go
Yes,
for it.
that's one. The second thing is, you can call it mindset or skill set, but it is like asking yourself the question, how big can this business become? Right. So if you go, you take the last 100 years of data, I think the stat is something like 72 companies in public markets have been responsible for 50% of return generation, right? So you see power law everywhere. And in a micro way, we think about that. We're not public market investors and we're not investing in Microsoft, and that's not how we generate our returns. But that same logic is kind of how we think about investing. We approach most businesses with the starting question of like, how big can this business become over a long period of time? In 2016, let's give you an example. Like just to take our 2016 cohort, there are 3 companies in there: Allegro, Klarna, Altidomus. We made other investments in that year, but to take these 3 businesses, Klarna was about $300 million of revenue. This year, it is going to do more than $3 billion of revenue. Allegro was about 300 of revenue. This year, it will do about $3 billion of revenue. Altidomus was about $150 million of revenue, 150 million euros of revenue. This year, it'll do billion euros of revenue. Now, these are like easy numbers to just reel off, but you don't get there without a deal team and a set of deal partners that sit down first and ask themselves the question, how big can this business become over a long period of time? And then make the sorts of decisions that allow that company to unlock that potential. If we had approached those companies with the logic of how profitable can they be in year 2 or 3, they would have been much more profitable than the companies that we had in 2018, 19. But they would have been much smaller than they are today.
Those are 3 very different businesses too.
And they're 3 different businesses. Different.
Altidomus is a very different business.
Yeah.
B2B versus a consumer finance business like Klarna. But it's funny, out of the corner of my eye, as you were talking about that, I see a sign that says multiplying potential.
Yeah.
Right. So that long-term mindset, I think, is indicative of how you think about things. But on the point about the most recent fund that you're currently investing out of, a large number of those companies being either founder-run, still founder-owned, or founder still has involvement, do you tend to find that those businesses often do better than businesses that don't still have founder involvement?
I don't think we've seen like there's a difference in the performance of those companies. And look, we say like it's to see a founder who's been able to run a business from zero to multiple billions of dollars of value is really an incredible thing, right? I mean, that means multiple phases of evolution of a business to be able to operate through, and different needs, right? You kind of go through do we have a product market fit? Kind of early phase. Yes, we have product market fit. Like, okay, like, can we get some customers? Like, how do you sell customers on that? Okay. And then how do you scale that product market fit into a business that has, a durable, economic model? These are very different skills that involve very different capabilities. And so founders that can do that, I mean, the founders that we're backing at the scale we're backing have proven almost by definition that they've gotten to that level, that they are all-rounders. They've got kind of all of those capabilities. So typically somebody earlier in the private equity world has resolved a founder who is only good at that product market fit phase. They just can't scale a business to get to the level where we are. So like they've already either realized that and brought somebody else in, or the business just never makes it to that phase that we would see them. So, but because it's most of the companies that we're backing actually have this feature, we'd say like, we know that those work well.
They've already made it to that verified error. And
So, yeah.
Another thing I want to touch on related to Permira is I think you have an interesting structure as a firm. You have co-CEOs. You also have co-heads of every investing function or business unit. Why do that?
We have a very collaborative internal model, and without designing it towards co-leadership, we kind of naturally tend towards co-leadership. And our philosophy about it is two people properly set up are very more effective than one person. Like I say, like I am much better as a co-CEO than I would be as a sole CEO. And why is that? It's that our job as investors, as managers, a way of looking at it is I need to make a certain number of very high quality decisions every day. And I want those decisions to be, the most important thing is that they're good decisions. But settings, fixing how good the decision is, you want to be able to make those like as efficiently as possible. And I can just make those decisions faster when I'm co-ideating with somebody than if I'm sitting by myself with a sheet of paper and need to be like, well, am I really sure about that? And if I have like the same view as Dipan about making a decision, like I feel more confident in moving quickly on both the quality and the content of those decisions. And that kind of, that's just us and co-running the firm. That's also true in our sectors, which, as you said, our sectors are all co-led except for healthcare. Our climate team is co-led. Our credit team is co-led. So we have the model, we just have the belief that two people ideating together just manage and decide quicker and better than one person by themselves.
What's the hardest part about having co-heads or co-leaders?
Oh, it's just the communication side, right? Like when you're trying to, it means you need to preserve and protect time together. It's like a marriage, right? Like you got to make time for communication. Things just often, you can't make assumptions that things will just work without kind of a lot of, discussion. And so you got to protect your time to just talk and do that co-ideation, right? Co-ideation, when done effectively, is phenomenally powerful, but you actually have to do it, right? And you have to protect the time to do it. And like we just live in a world where if you just respond to the things that come at you, you can occupy more than all of your day just responding to crises, right? Just like urgent things that pop up. And so needing to like bracket and protect the time of like, hey, we're going to spend, a couple hours every week just talking about the things that we feel like we need to talk about and make decisions about.
When you think about the Permira culture and DNA, how does that relate to what you just talked about, which is what you want your brand to be?
Yeah, we are going back to the founding of the firm 40 years ago. I mean, we are a firm of entrepreneurs, founded by entrepreneurs, run by entrepreneurs, developing entrepreneurs, and then working with, in the outside world, in the companies that we invest behind, entrepreneurs. And so that works. Like the founders, the CEOs that we work with kind of look at us and see that we have also been business builders in the same journey that he or she has been on. And that's really key to nurture in the culture of the firm. So we are not command and control internally, even though we control the firm. What we have is a culture of, we call it bounded entrepreneurialism. We want to grow really good risk assessors, really good investors over time. And in our experience, the way you do that is by giving responsibility, autonomy into the organization to develop really creative ideas, but then bound it with the experience and the gravitas of the more senior experienced members of the firm. And that is, it's easy for us to do because that's the culture that we have. It's not actually easy to create that kind of dynamic culture where you got, I love nothing better than when a, 25-year-old the firm comes into my office and is like, I've got this idea and it might be a crazy idea, and then sometimes it is a crazy idea. Sometimes it's actually got the germination potential of something really brilliant. And that's where, we have a culture of being able to kind of fan those flames to be able to generate really neat opportunities and idea for us to invest behind. And that's why we tend to, with that culture, we get to certain kinds of trends, industry pockets, like, theses earlier than other people do, because we're able to kind of capitalize the entire organization's creative thinking.
Is that a process, or is that just an organic thing that you let unfold?
I mean, I like to say culture doesn't happen in moments like this. Like, culture doesn't happen when you are with a microphone at a podium telling the organization what you want them to be. You can accentuate your culture with that. Culture happens in, your office late at night, or in a conference room when everybody's exhausted and like throwing, paper balls at the model, trying to figure out like, how do you make something work? And so that's a really hard thing to dictate, right? So it's an organism, the culture. And so you need to, and like our job as the partners of the firm is to see areas where the culture is, you can support it and jump into those, opportunities. And if you see something that's countercultural, snuffing that out very quickly. But those tend to be how you bound it around the edges, rather than, making the culture in and of itself. The culture needs to like exist on its own. You can just sort of manage it at the edges.
Why decide to start working with the Wealth Channel?
We've been really an institutional only private equity investor for a very long time, really the inception of our entire life. And in some ways, we've been the victim of our own success of having an incredibly high re-up rate with all of the institutions who've been, good enough to partner with us and give us capital in multiple funds over the years. And the two of us have said, not just the two of us, but with the partners of the firm, it would be a good thing to diversify kind of our base of capital into new channels. And wealth is actually the most interesting new channel for us to be able to achieve some of that diversification. And it's not to say at all that we're trying to move away from the institutional base that we have. It's like a really excellent base of partners we've got. We just want to diversify a bit. So it's not about maximizing the capital that we have. We've got plenty of capital in the building. It's really about achieving a bit more diversification of that base.
You made the point. Like it is 90% of companies are private. 2%, 3%, maybe 5% of household wealth is sitting in private market allocations, and so there's a mismatch there. And it's a great product, like the private equity product for investors that understand the liquidity versus return trade-off and have long-term timeframes, is a phenomenal product. By definition, it should, and it has done over long periods of time, and it ought to for the next few decades outperform public markets, because you have control, you have the ability to think on different timeframes, you have access to incentive tools and therefore talent that you don't tend to have when you're a public company. So all of those things are great and will be great for the right kinds of investors. We just happen to think that the closed-end structure makes sense for people that really understand that illiquidity versus return trade-off.
So when you think about the evolution of the wealth channel itself, it's still very early on. What do you think it's going to take to educate the wealth channel on why private markets, and two, why the part of the market that you cover, growth-oriented, control investing in private equity and private credit as well?
I think there's two elements. I think there's one part I think is very well advanced, which is the individuals that are in the wealth channel understanding the fact that there is this massive opportunity in private markets that mostly they've been missing out on. And some of that awareness you get by reading, the newspaper and seeing larger and larger IPOs, or like companies that aren't going public that are, developing and kind of building equity value kind of in those private markets. I think that's kind of there. Like, I think the market, the wealth, clients can understand that. And then what needs to happen really is the enablement of the channel, the financial advisors, in our case, through the private banks, to understand, our product, how it sits in the ecosystem of available products that individual clients can, decide to commit to, and, bringing that to them. So like our job on that, what needs to happen is effectively for us to help enable all of these financial advisors to understand what it is that we do, the part of the ecosystem that we operate in, so that they can bring that to their clients and kind of together make a decision about what makes sense for their desires and their investment goals.
What brand do you want Permira to be known as to the wealth channel?
Growth, sector-led, with control. And this is, it's pretty distinctive. In US, Western Europe, like we operate globally, we operate across multiple sectors. That's what we'd like to, when somebody looks at how they balance their portfolio in the private markets, if they would like to get access to compounding businesses, market leader compounding businesses in the private markets at the scale we operate, kind of asset values companies that are in the high hundreds of millions, billions of revenue, that's where we sit. And that's a really nice segment of the market. That's what we would like the market to understand about where we operate.
How do you think about the next evolution of the firm? You obviously started as part of a UK financial institution, Schroders. That's evolved. You've now grown to 40 years old as a firm, gone through leadership transitions. You have co-CEOs. How do you think about the next phase of growth and evolution in the firm?
We feel really good about the platform of where we are at Permira over the last 40 years. We've got an outstanding credit business. The private equity products are very well developed, very mature. And where we see the next evolution is really about deepening our capabilities in the core. There's like no new market that we need to tap into from an investing standpoint that we're seeing today, outside of what we've got kind of on the table that we're investing behind. And so it's really about getting better and better at what we're doing in the core. So deepening our value creation capabilities, deepening our network, and just being better at what our core is.
Brian, Dipan, what a great conversation about how you've evolved Permira in the context of the evolution of private markets, how you think about the firm, how you think about growing the firm, but also staying true to who you are.
Thank you. Thanks. Enjoyed it.
Thanks for listening to this episode of Alt Goes Mainstream. I hope you enjoyed it. You can read more about alts at my Substack, altgoesmainstream.substack.com. Thanks a lot and have a great day.
We're going